I don't know if you've had a chance to look at what the World Bank is saying, but I don't think it comes as a surprise to a lot of people. But when you take into consideration what happened with the jobs report on Friday, job gains are welcome, as you point out, and may suggest the economy hit a bottom in the United States in May. Is it too soon, given everything we're digesting, to make that kind of prediction?
It is, because we do know that the PPP, the Payroll Protection Plan, actually did help in boosting those job gains. We've seen changes to the plan since then that will stretch out the job gains more over the second half of the year, less concentrated, so that we'll actually hopefully save more small businesses out there. I think the other important issue is that there's a lot of headwinds that persist, and you're going to see that echoed in Jay Powell's comments when he talks about, after the Fed gets done, that the government is not done doing what it needs to do. The Federal Reserve can lend, but it cannot spend. And Jay Powell has been very consistent on his pleas of Congress, particularly for state and local transfers for state and local governments. We have a headwind of June 1st, where not only do we have many things of the support that we provided excuse me, in the United States playing out, but also June 1st is when many fiscal years start for state and local government budgets. And we've already seen the cuts continue at the state and local level. And that could be a major headwind to the economy gaining momentum in the second half of the year if we don't see transfers to state and local governments. And this is every state is affected. California is, of course, was the largest state to go in at the beginning of the shutdowns. But we've got places like Florida, Nevada, Texas, all being affected by these closures because of the loss in revenues that they suffered for nearly 2 months' time and the cost of fighting COVID itself. So there is no state that goes untouched, and we really need to continue to see fiscal stimulus out there. Much of what the U.S. had, there was a lot of it, not all of it is targeted as we'd like, and now we really need some more targeted stimulus or relief, as I'll put it, to get through the summer and make sure that this recovery really takes hold and doesn't dip into a double dip in the fourth quarter when we might see a second wave of the infection.
Diane, it's Julie here. Do you think the danger is, though, that with the jobs numbers on Friday, that takes some of the wind out of the sails, that Congress will not be as motivated to make the moves that you're talking about?
Well, we certainly saw some of that initial reaction from the White House, that they were less motivated to, some of the speakers from the White House saying they're less motivated to put up fiscal stimulus. It is an election year, and that probably goes to the favor of needing more fiscal aid at this stage of the game. And, we're really not going to see the economy, to declare victory too soon is really a dangerous thing to do. And I think it's really important to understand where our cliffs are. We know as of July 31st that the extended and expanded benefits for people will end in terms of unemployment benefits, yet a lot of people will still be unemployed. And that could really set you up for a cliff over the summer. So yes, there is some, risk that the good numbers we saw take some of the wind out of additional fiscal relief. That said, I think the case is still very strong. And I think you're going to see Washington have to step up to the plate. Did they step up to the plate as much as I'd like them to? No, I don't think they will step up to the plate as much as I'd like. I think that there still is sort of a lack of recognition of how damaging COVID-19 has been and how damaging the behavioral effects are as we continue to deal with, sort of recurring outbreaks across the country.
Diane, it's Julia LaRoche. And to that point, you wrote this in your note, and I thought this was really interesting, so I'll read it for our viewers. You said, quote, "We really need a new way to talk about recessions and recoveries in a post-COVID world." I was hoping to expand a bit more on that idea.
Yeah, one of the things that's really going on out there, and a lot of economists were sitting together talking about this, and, the idea of an expansion and a recovery is, there's the part where you sort of contract for a while, and then you get to regaining ground lost. And that's how you typically think of recessions and recoveries, where we're going to be in the hole for a long time. We're only operating at a small percentage of the economy's capacity for a while until we get to a vaccine with COVID. We hope that long time won't take as long to recover as we saw from the Great Recession, but the pain is still there, and it's so large up front. And so to put it in this sort of traditional framework that we talk about, recession recovery, it really does an injustice to the ongoing and sustained pain of lots of unemployed people, a very high unemployment rate for a very long period of time that I think you're really not getting the grasp of when you talk about it in those terms. And so we almost need a new dictionary, a new verbiage to be able to talk about a COVID-related recession, which is a service sector recession. I mean, how long will it take until we see flights restored to the levels we saw prior to the crisis globally? A very long time. When is the next time cruises are going to be as full as they were prior to the COVID crisis? A very long time. We're talking about an 80-year trend in the service sector that we're derailing temporarily, but that temporarily is going to mean a lot of displacement and industries, an economy that looks very different than what it did pre-COVID for a while.
Diane, it's Brian Chung. It's great to talk to you again. And it sounds like, based on what you were just saying, that we should be buckling in for what could be a long recovery. Now, when you look at what the Federal Reserve is going to be doing with their FOMC announcement here on Wednesday, what are you going to be dialed into when it comes to Jay Powell's testimony? We know that the Fed has already done a bunch of stuff with regards to taking rates to near zero, quantitative easing, its 9 liquidity facilities. If it is going to be a long recession and we should expect the labor market to be in a slump for quite a while, how can you expect to see maybe the Federal Reserve prop that up when the recovery does eventually come?
Well, they clearly are, they continue to surprise us in their ability to sort of print yet another arsenal of tools to fight and combat the weakness in the economy. And I don't think that they're done doing that. We are going to see down the road, I don't think at this meeting we'll see down the road some more specific forward guidance. They are going to release their forecasts again, which we haven't seen in quite a while, those infamous dot plots. And I think in that you'll see some very, low rates for an extended period of time, and also a lower neutral rate. Also, I think you'll see that the Fed is sort of worried about potential growth being much weaker than it once was in their forecasts as they line up their forecasts for this year. But as we get in later into the year, and if the economy really does struggle, as I fear it will, to continue to reopen and not reopen as smoothly as many would like, the Fed's going to have to be tying their forward guidance on interest rates much more closely to what the unemployment rate is, what inflation is. They're going to have some actual targets tied to how long they're willing to keep rates down. I do also think we likely will see some yield curve control, because I think we're going to see a deflationary shock from this. The Fed is going to want to go ahead and intervene and deal particularly with some speculation that we've seen in the 10-year market on the 10-year Treasury, but we could see some yield curve control where they keep those rates unusually low. And what they're really saying is what the market is already saying. The market is begging for fiscal policymakers, for Congress, to spend more with negative yields after adjusting for inflation. They're saying, please invest in the future of the economy rather than worry about deficits and reducing those deficits at this stage of the game.
Diane, given what you just said about the need for Congress to get involved, what happens if they don't allocate money to the municipalities and the states? We know there will be layoffs, but as investors, where would we start to see that impact? Would it be in the muni bond market? Would it be elsewhere?
It's going to be really across the board, because we've not only got the muni bond market very stressed as a result of this, and the Fed is willing to buy, but then, of course, you have much more precarious muni bonds and muni bond ratings. I think what you've also got is the issue of who gets hit. You're going to really hit higher education very hard along with education. So you're talking about 1 in 8 workers are employed by state and local governments now, and we've already seen a major hit to education. This also exacerbates the inequalities that we're seeing out there, and it really is something that kind of undermines the entire infrastructure of the U.S. economy. And it's something that we've neglected for so long to do it. One, you sort of get to the point of having, a straw breaking the camel's back in terms of how much we're compromising state and local governments. And again, also the social unrest that we're seeing out there, this ups the ante on that as well, because you're taking away much needed services from localities that are the least served as it is. And so you're going to be pulling those forward as well, those kind of cuts. That's just not a place we want to go right now.
Grant Thornton, Chief Economist, Diane Swak, thank you very much for joining us. Let's hope members of Congress are listening to what you have to say.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.